Hey, Jason here. First time back in a while. Went on vacation. Took some time off for the first time in years. But I'm back now. And today I'm going to answer the question for you. Should you invest in Square Inc. stock ticker SQ? This is a stock analysis for Joel B, who requested this on YouTube. Before I get to that though, I'm going to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms. Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release new videos, because we're releasing new videos all the time. Okay. Apologize again. Coming back from a vacation. I don't want to do this ever, but I have to, because if I don't put a disclaimer in here, I get nasty comments in the comments below, so I have to put this disclaimer in here. This is for educational purposes only, to help you learn how to spot potential red flags in investments, and to learn how to spot great potential things when it comes to looking positively at a stock. This is based off my written preliminary analysis, which you can get for free at the link below in the description, and I'll tell you more about that later. This is the visual part of that analysis based on my years of experience and research and analysis and valuation. I hope you can tell I'm having so much fun here right now. Sorry, sarcasm. Sorry, I lost my thought process. Where was I? Oh, I do not short stocks ever, so I don't short any stocks I talk negatively about, and I don't own any stock in a long position that I talk positively about. So I do not profit from these analysis videos on either a negative way or a positive way. Again, this is to help you figure out how to avoid terrible stocks, to help you find potential great stocks faster. Why should you listen to anything I have to say? In the first 9 years of my career, I've produced average annual returns of 23.5% on average per year, not compounded. Over the first 9 years of my career, every year. This puts me just behind Warren Buffett, who produced 24.2% returns in the first 9 years of his career, and legitimately makes me one of the best stock pickers in the world over the last 9 years. I'm not saying that to brag. I'm just saying that to prove to you that I know that I'm talking about at least a little bit, and to help prove to you that I'm someone worth possibly listening to. Okay, again, sorry about that. I don't want to do it. I have to do it because every time I don't, I get disgusting comments. So let's get to this analysis for Joel B. While I'm bringing that up, actually, I'll talk about that later. So, because that came up faster than I expected. If you haven't seen our other videos, I purposely do not research companies before I do these analyses. I do that, or I do not do that, so that I'm not biased either negatively or positively by a company's story. I don't care about the story at all until later, and even then, it doesn't matter, frankly, much to me. I care about what the company's doing now, what it's done in the past. At the very first, this is my very first kind of screen, if you want to call it that. This visual preliminary analysis look. I require strict criteria. If the company does not meet that strict criteria, I discard the company and I do not do further research on it again, because I don't want to be biased by the story, either positively or negatively. I let the numbers speak for themselves at this initial stage, which is why I do not do prior research in this company. However, some of these companies, like today's Square, I've heard of. I think I've used their products several times. I used to sell stuff on Amazon and eBay. I don't think they had stuff with them, but I am familiar with their products, at least what their products used to be, with the what was it called, the USB thing, or the thing you would plug into your phone and you could take credit card payments, stuff like that. I think this is the same company. Again, let's see here. I'm assuming it's the same company. Provides payments, acquiring, yes, service to merchants. Okay. Okay. Huge market cap. Huge PE, forward PE. I don't care. Again, if you see my other videos, I don't care much about PE. But when I do, I want this to be under 20. This is at 200, which is one sign the company might be enormously overvalued. Does not pay a dividend. Frankly, that's not surprising because this is still a relatively new company. Revenue has skyrocketed from 203 million in 2012 to 9.5 billion in the trailing 12-month period. Again, this is not surprising to me. I write for financial sites and financial newsletters, so I'm researching researching and learning financial news all the time. And frankly, personally, I'm interested in stuff like DeFi, blockchain, and other tech-related stuff. So this fact that Square's revenue has skyrocketed in this time does not surprise me, especially when you consider the fact that you could receive payments anywhere in the world on your smartphone with their original product offering. They were they were the pioneer in this place. They even overtook PayPal, if memory serves me right, at one point in terms of receiving payments. I don't know if that's still the case, or a lot of merchants to receive payments. Sorry, I don't know if that's still the case, but at one point I'm pretty sure they overtook them, at least in the mobile space. I'm positive of that. Operating income is negative. That is actually, frankly, a little bit of a surprise. Not hugely negative, negative 19 million compared to revenue of 9.5 billion in the last 12 months isn't a huge deal. I look for anything above 10%, positive 10% on a consistent basis here, so this does not meet my threshold. But frankly, this is a growth company, so they're reinvesting all their capital. So that's why I said it's not surprising that their operating income, well, it's a slight surprise. Even though they're earning a ton of money, or they're making a ton of money in terms of revenue. They're not earning a ton of money, making a ton of profit. At least in terms of operating income, their net income is positive, which, again, I don't typically care about, but that looks like it's coming partially from share issuances and share dilution. I talk about this quite a bit in other videos. So reference those, which you can find below for free in description. They're using these shares, it looks like, to fund their growth, or at least in part to fund their growth, and to continue growing rapidly. Not unexpected, again, because they're a high growth company in the tech arena. A lot of tech companies, or a lot of tech companies and high growth companies do this. It's not a necessarily huge red flag for a tech company or a growth company to do this, like it is most of the time when I see other companies, kind of quote-unquote regular companies, do this. Still not great, but as long as they're allocating the capital well, which frankly, with their revenue growing from 203 million in 2012 to 9.5 billion, I would assume they are, then it's not a huge red flag. Book value per share has gone up. That is a good thing. In 99% of cases, the only caveat to that is when it's from goodwill. That's not a good thing when book value per share is rising for that. And I talk about that, I think, in the Cody video and ExxonMobil videos. So reference those. Below this, again, those are for free as well. Book value per share rising, not a huge deal for most modern companies, especially kind of tech-related companies, but it is a sign that the company's underlying intrinsic value is going up over time. Positive free cash flow, sorry. Okay, interesting. So their free cash flow is higher than their operating profit. If you see that, at first glance, it doesn't make sense, right? Because operating profit is profit from operations. Free cash flow is pretty much, in a simplified sense, the money left over after paying for all expenses. So free cash flow should be lower than operating income. It is not in this case because, in part, the share issuances, that's also why their net income is positive and higher than the operating income, or at least one reason. Other reasons could be accounting stuff, which we'll find out about in a second. Another thing might be debt issuance as well, which I don't see on here. We won't see for a little bit still. ROIC, good, not great. I look for anything above 10% on a consistent basis. In the last year, it was 6%. Not great. Not terrible, just kind of okay there. Free cash flow to sales, I look for anything about 5% on a consistent basis here. They've averaged probably right around 1 or 2%, including the negative numbers. Might be negative a little bit actually, with the negative numbers earlier in the decade as they were growing rapidly. Again, not a huge surprise because they're reinvesting all their capital back into growth, but not great either. Cash. Ooh, that's interesting. Almost 60% of the balance sheet is in cash and short-term investments. That provides an enormous margin of safety, depending on what the absolute dollar amount is of that. Because of that, they actually have a decent amount of debt. We'll see the kind of total numbers there. I would want to know what these other short-term liabilities are. That's 32% almost. If I were to dig into the footnotes, I would want to know what those are specifically. Efficiency, the cash conversion cycle is going down over time. Frankly, I don't know why cash conversion cycle matters much for them. This matters more for hard asset kind of companies like retail companies, car companies, stuff like that. I don't know why, frankly, their cash conversion cycle is even reported here. I don't know if it's because of their hardware they produce and sell. I just frankly don't know. However, it going down is a good thing because that means they're becoming more efficient over time and becoming more profitable over time, which shows up here with the operating margin going from negative 42% in 2012 to negative 0.2% only in 2020. That shows, or that's one reason the cash conversion cycle is so important. I talk about this in several videos as well. Again, you can find those for free below. Debt to equity, look for anything below 1. At 1.3, it's slightly above that, not a huge deal. Okay, let's bring up the actual balance sheet. So they have $3.43 billion in total cash equivalents, and short-term investments. Again, that provides an enormous margin of safety. What's the market cap again? Not as big of a margin of safety as it could if it was, say, like a $10 billion company, but cash, having more cash than debt, is still better than not. Nothing else of major note so far. Goodwill, they don't have a huge amount of goodwill, so that means the intrinsic, because they don't have a lot of goodwill, that means the intrinsic value, with their book value rising, that means their intrinsic value of their company is going up over time, which is a great thing, because if it's funded, or if their book value per share is going up because of goodwill, it's not a great thing. In this case, it's only a little bit of goodwill. Okay. Long-term debt. Short-term debt, did I pass that? I did. Oh, probably because they don't have hardly any short-term debt. So we'll not even talk about that and go down to long-term debt. They have about $2 billion in long-term debt and capital leases. They have, what was it? $3.43 billion in cash and cash equivalents and short-term investments. So again, having more cash than debt is a good thing. Gives them more margin of safety, makes potentially investing in the company safer. Those are all good things. Liabilities, nothing really important down here. Ooh, I like this now. This must be a new update from Morningstar where they have the operating leases in here, so you don't have to go to the to the actual 10Ks to find that. I like that. Okay, nothing else of major note here. Let's go to the cash flow statement, see if we see anything major here. Change in other payables. That's a big number. In the last, oh, that's not it. I was looking at the quarter to, I have to remember I'm looking at the quarter compared to the full year. That's why it's a big number. Okay, not a huge difference there then. They sold an investment for $1.6 billion in last year. They bought an investment for $2 billion. And I'm not seeing huge amount of debt issuances. Oop, need to go down further. Okay, so they issued in the last year about $2.5 billion in debt. Again, not a surprise. Most companies did that during the COVID times to raise capital, to give more margin of safety. Not a huge deal, especially because they're profitable, or they're almost profitable on an operating profit basis. But that's also another reason the share issuances and the debt issuances are why their free cash flow is higher than the operating income. Again, usually free cash flow is either the same as operating income or lower. But because they issued shares and debt, that's why free cash flow is higher. Not necessarily a red flag, just something interesting to kind of note. Can be a red flag if the company's issuing a huge amount of debt and shares and then not allocating that capital well. That's a massive red flag. But in this case, not a big deal. Okay, so far, Square looks like a great potential investment until we get to the valuation. Valuations are absurdly high. Again, I don't care much about PE, price to cash flow, forward PE, but I would like the company to be selling underneath 20 on all those at 576.8, 320.7, and 200 on those respectively. This is way over that amount. The EV to EBIT, this is the most important number here because enterprise value includes cash and debt, and 99% of all companies on earth have cash and debt. So that's why this number is important. I look at companies, or anytime before I buy a stock, I'm a long-term value investor. So anytime I look, or anytime before I look to buy a stock, I think of owning shares in the company as owning a potential or a partial ownership stake in the company, because that's essentially what you do. And this gives you a estimated value of enterprise value. This gives you an estimated value of what you would have to pay for the entire company. In this case, the enterprise value to EBIT is 414 rounded up. I look for anything under 8 to consider the company undervalued on this metric. I never buy companies when they're overvalued. I, on occasion, buy companies when they're fairly valued, but preferably I look for companies that are undervalued to consider buying them. So in this case, I look for anything under 8 at 414. Square is enormously overvalued, which again, like I've said throughout this, is not a surprise. A lot of companies, most companies in the tech industry are overvalued, and most companies just kind of in general overvalued right now. Didn't necessarily think it would be 414 here for this EV to EBIT. But that is not a surprise to me. So overall, Square looks like a great potential investment, but you need to wait until it becomes undervalued to buy, in my opinion. I would not buy this stock right now. If you own it, that's a different story. You may just want to hold it for long-term type of thing. If you are looking to buy it now, I would not recommend that because it's so enormously overvalued on that metric, or all of the metrics I talked about, all the relative valuations. Good company, going to keep growing, going to help continue to transform the financial world, especially with DeFi and that kind of stuff coming up. There's just no way I could pay a 414 multiple on enterprise value to EBIT for it. Again, I look for anything under 8, so there's no way I could buy that right now. What that means, is it a bad company? No. Is it overvalued? By the metrics I looked at, yes. Again, doesn't make it a bad company. Just makes it one that I can't invest in right now, because I don't invest in these huge growth stocks like this. I just don't. If something is undervalued, then that's a different story. But these kind of companies are perpetually overvalued for me. For example, I use Amazon weekly. My wife uses it almost every day. Love it. Love its products. I buy books from there on a consistent basis. Love its service. Love its customer service is fantastic. Love the company. Can't buy it. It's too overvalued for me. Always. Again, these high growth stocks can make a lot of money, and I know that. But my goal is to preserve capital, number one, for my investors. And I do that by buying undervalued or at worst fairly valued stocks. So I hope this helped. Hope this has been interesting. This was for, again, Joel B. Thanks for requesting this analysis from me. Very good, again, very good looking company. Just too overvalued for me to consider buying based on what I require from an investment perspective. If you're a growth investor, might be a great company for you to buy. Again, I don't invest in growth, so I don't really talk about that much. If you have any questions, comments, concerns, if I missed something, if I didn't explain something well enough, let me know in the comments below. If you want me to look at a company like this for you, let me know in the comments below. Every single stock I'm pointing over here to on my calendar, on my blog calendar, is requested from my viewer. If you want me to evaluate a company for you like this, let me know. I'll evaluate any companies in the world. The only caveats are I will not research or evaluate banks for you because I don't evaluate banks. I will not look at insurance companies because you have to actually look into 10Ks for that. And the company has to be generating some kind of revenue. A little bit ago, I was getting these companies requested where they weren't generating any revenue. So there was essentially no analysis because there was no profits, there was no cash flow, stuff like that. So has to be generating revenue for me to evaluate as well. Other than that, anywhere in the world, I'll evaluate stock for you. Let me know in the comments below. If you're listening on YouTube, thanks so much. Make sure to like, comment, share, subscribe, and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, thanks as well. Make sure to do all that same stuff, except we also really appreciate a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more help on how to become a better investor faster and how to evaluate companies faster, check out the free resources below in the description. You can get access to our 5 free gifts, including the written preliminary analysis template for this, so you can evaluate stocks faster and better. You can get that as part of our 5 free gifts, or you get that as one of the free gifts as part of our 5 free gifts promotion. Also below this, you can get a copy of my book, How to Value Invest, for free. And you can also get a free copy of our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those resources for free below this in the description. And if you're looking for more specific help from me on how to become a better investor faster, make sure to check out the information on our masterclass below this as well. But until next time, have a great day. Talk soon.